All right, welcome back. Let's quickly take you through our conversations. The basic conversation which I want to take you through now, the fiscal monitor. Let me just quickly run you through the speakers that you will get to see in the next couple of seconds. Victor Gaspar is the Director of Fiscal Affairs Department at the IMF. We also have Paulo Mauro, who is the Deputy Director of Fiscal Affairs Department. Paulo Medias, who is the Division Chief, Fiscal Affairs Department of the IMF. I must also say that Nigeria's Finance Minister, Zainab Ahmed, has been really involved in some of these high-level discussions. A lot of closed-door meetings have also happened where Zainab Ahmed is representing Nigeria, as well as the Central Bank Governor Godwin Emefiele. Both have been very busy here at the headquarters of the IMF, as well as the headquarters of the World Bank. So let's get to see this. It's an interesting next couple of minutes. I must tell you, highly intellectual. Don't fret. Even if you don't understand economics, don't fret. Just sit down and learn. We'll be right back.
Three years after the pandemic, fiscal policy has moved a long way towards normalization. Already in 2021 and 2022, debt and deficits fell rapidly from record levels. To allow for extraordinary support in the early stages of COVID-19, many countries suspended fiscal rules. Now, most of these countries plan to go back to rules, often after some rethinking. However, despite having come halfway down from unprecedented levels reached in 2020, global public debt is more elevated and projected to grow faster than foreseen before the pandemic. It is anticipated to start going up again by about 1.25 percentage point per year and into the medium term. By the end of our projection horizon, 2028, public debt in the world is expected to reach almost 100% of GDP, back to the record levels set in the year of the pandemic. It is worth pointing out that primary deficits are also predicted to stop declining and to stay above pre-pandemic levels over the medium term. These global trends are shaped by some large, advanced, and emerging market economies. Brazil, China, Japan, South Africa, Turkey, the UK, and the US are all projected to see increases in public debt ratios in excess of 5 percentage points of GDP over 2023 to 2028, with the two largest economies contributing most to the increase. In the United States, public debt to GDP is projected to increase by 3 percentage points of GDP per year from 2023, about twice the pace projected pre-pandemic. By 2028, the US public debt to GDP ratio is expected to exceed 135% of GDP, well above the pandemic peak. China debt to GDP ratio has increased continuously after the jump up in 2020. There was no decline in China in 2021 or 2022. In 2028, it will have almost doubled pre-pandemic levels and surpassed 100% of GDP. Excluding China and the US, world public debt ratios would be slowly declining over the medium term. Rising real interest rates increase borrowing costs for countries, making fiscal management more challenging. For countries dependent on foreign currency borrowing, tighter global financing conditions are also a source of pressure, as exchange rate depreciation can lead to significant surges in debt. Additionally, rapidly increasing interest rates may create complications for financial stability, as seen in recent financial turbulence in the US and Europe. The Fiscal Monitor makes a strong case for fiscal tightening in many countries based on four arguments. First, fiscal policy can and should support monetary policy in bringing inflation back to target. Stronger fiscal balances contribute to slow down aggregate demand and hence moderate required increase in monetary policy rates. Second, a more balanced policy mix, again, by moderating sharp increases in policy rates, contributes to financial stability. Third, a sound overall balance helps limit public finance risks and builds fiscal space to respond to adverse macroeconomic or financial development. Empirical evidence indicates that countries with insufficient buffers that enter a financial crisis suffer deeper and longer recessions. This is particularly the case for emerging markets. Fourth, stronger balances also contribute to long-term debt sustainability in a demanding context that includes demographic trends, digitalization, and the green transformation. The Fiscal Monitor explores how fiscal policy can help disinflation and protect vulnerable groups at the same time. The results of our analytical chapter show that when monetary policy acts alone, low-income households bear the brunt costs of disinflation. However, fiscal tightening accompanied by target transfers moderates interest rate increases required to achieve inflation targets and limits the decline in consumption for most households, including, by construction, no fall at all in the consumption levels for the poorest households. Looking further ahead, sound fiscal policies today and over the medium term enable governments to contribute to sustainable and inclusive development and to a resilient society. Low-income countries have insufficient fiscal space with tax to GDP ratios too low to support the state's economic policy role. Improving tax capacity is crucial for public credit, financial development, and safe integration in world capital markets. It also helps to create room to respond to shocks like the food price surge or extreme weather events, and is necessary for the achievement of the Sustainable Development Goals. Sound public finances are crucial for green investments and tackling climate change. Business as usual will deliver increasing greenhouse gas emissions this decade. Urgent country, individual, and global collective actions are required to limit temperature increases to tolerable levels and thereby avoid catastrophic climate change. Climate change is the topic of the forthcoming Fiscal Monitor in the fall. The Fiscal Monitor explains that the pandemic was a very large shock that justified very large responses all around the world. And so the jump in debt and deficits at that point in time was unprecedented. The pattern is so strong that you actually see it even better if you have intra-annual data for the year of the pandemic itself. The immediate reaction of fiscal policy was quite impressive. In the following 2 years, 2021 and 2022, there was quite a sharp correction of debt and deficits, so much so that the fall in debt levels over the 2 years is the largest on record for 70 years, right? So there is a process of a very sharp response for the pandemic and then an expiry of some of these extraordinary measures at the same time as the financial system, the economy, the population get used to the pandemic itself. It was a process of normalization in this sense. But at the same time, many countries, as I indicated in my introductory remarks, suspended fiscal rules. They're now going back to rules. But are there the same rules? Well, actually, there is quite a rethinking going on and some adaptation in the rules going forward. So there is a normalization, but we don't know yet how the new public finance normal will look like. On the first question, that is, how likely is it to have a generalized sovereign debt crisis right now? You may recall from yesterday's press conference on the World Economic Outlook that the adverse scenario of the WEO has a probability of about 15%. It's a severe scenario, but nowhere near the type of scenario that you portray. So the probability of your scenario must be very low. Still, we do know that sovereign debt crises in advanced economies can happen. You mentioned the sovereign debt crisis in the euro area in 2010, 11, 12, 13. And it's clear that risks have increased, and it's very important to be alert to developments in financial markets. 6 months ago, we were discussing some disturbances in the market for treasury gilts in the UK. So clearly the risks exist, and those risks are among the public finance risks that have to be managed, and extreme scenarios should be avoided to the extent possible. On the issue of inflation and fiscal policy, that is a very important topic right now. The topic dominates the fiscal monitor this time. It is covered both in Chapter 1 and also in the analytical Chapter 2. Our base message is that fiscal policy in many countries can and should support monetary policy, that helps the credibility of the disinflation process, and by contributing to moderate aggregate demand, helps limit the necessary increases in monetary policy rates, and therefore eases the burden on monetary policy. But I'm sure that my colleague Paolo Mauro has something quite interesting to add.
Sure. Well, let me come back to the question that you were raising. Is it too late? And I would emphasize that there are things that governments can do pretty quickly to reduce the fiscal deficit. Just one example would be to reduce any widespread support for energy prices that goes to everybody. So one quick way of reducing the overall fiscal deficit would be to make that support much more targeted only to those who truly need support. And that would pretty quickly reduce the deficit and be more efficient.
So there are different factors that can drive the differences in inflation dynamics in countries. One is when you have these shocks, for example, food prices or energy prices, the effect on countries can be very different. And for example, low-income countries, a shock in food prices can have a very large effect on the household's consumption basket, and that will be reflected also on a higher inflation. Also, if you lack a credible policy framework and the anchor inflation expectations, the effect of these shocks can be much larger and persistent over time. So that's part of the problem. Also talking about cases like Nigeria or Ghana, where you have a large dependence on commodity prices and you can have effects of very large increases in oil prices, for example. So what happens in oil exporters is that when you have very large movements in oil price, this can lead to destabilization in the macro and the domestic economy. For example, if you have a large revenue windfall, like we have seen in the last years, this can lead to inflationary pressures in these countries. Fiscal policy can play a major role here. So if you have a counter-cyclical fiscal policy, that is, if the government save part of these windfalls, that's going to reduce the inflation pressures, and it's going to build buffers so that you can react when the oil prices fall, and so you make the economy more stable. But if fiscal policy is pro-cyclical, so that is spending increases when oil price increases, that is going to create more problems for inflation. So ultimately, you really need a consistent macro policy framework with basically fiscal and inflation and monetary policy work together to ensure this macro stability and price stability. And the problem is once you lose the inflation expectations, so they become de-anchored, then it's going to be much more difficult. So you're going to have both tight fiscal and monetary policy for longer. And so the cost is larger to bring price stability back. So that's, I think, it's the problem it's facing for many of these countries.
We do see that low-income countries have, in our projections, very fast declining public debt to GDP ratios over the forecast period. We also see that this group of countries reacted to the pandemic much less than other countries. So the jump up in debt and deficits was smaller for this group of countries. What we see there is clearly countries that face severe fiscal space constraint, that face severe financial constraints. The recent developments, say in the last couple of years, show that these trends have become even more acute, and at this point in time, it is correct to refer to a funding squeeze for these countries. Given that the situation, even before the pandemic, was not brilliant, say, in terms of prospects for achieving sustainable development goals, we can see how serious the issue is right now. The first of the sustainable development goals is poverty eradication, and it turns out that poverty has turned up after many years of trending down. This is a very worrisome constraint. It's a very worrisome development. There are countries in this group that are in debt distress already or at high risk of debt distress. As you said, the IMF has as one of its priorities to contribute to ease those financing constraints, and it's calling on the global community and the community of creditors to act. One important aspect is to act on timely debt resolution. The G20 has the common framework to resolve these issues. It's important to have it working more expeditiously than up to now. And the IMF, the World Bank, and the India presidency of the G20 have put in place a global sovereign roundtable that is meant to help bringing together important stakeholders in this direction. One of the IMF's priorities for the spring meetings is to replenish the financial capacity of the PRGT, and we would like that process to be completed in the next 6 months or so. Moreover, there are debt problems that extend beyond the low-income developing countries. Some middle-income countries are unfortunately affected as well, and there the roundtable that I have already referred to can have a positive contribution. And I pass on to Paolo on India.
Sure. So on India specifically, of course, the global context is one of elevated debt and somewhat rising debt in the medium term, but it is very diverse, as Vitor just mentioned. The case of India is interesting because among the large economies is one where we project that the debt ratio will remain stable in the medium term, unlike some other large economies where we do see a continued increase. The debt ratio in India right now is 83%, so it's high. The good news is that is going to allow the debt to remain stable. In this year's budget, the authorities appropriately reduced the deficit somewhat. They did so by eliminating certain subsidies, and that goes in the direction of again, reducing demand and helping to...
Especially as the economies were hit hard by the crisis, but the fiscal space was much more limited than the rest of the world, so the deterioration was much smaller. Still, in more recent years, what we have seen is a very gradual reduction in deficits in general, and this is mainly driven by the commodity exporters. The other countries, the efforts is much harder, as you mentioned, because these countries are still facing with a series of other shocks, including the energy and food crisis. And so governments are trying to address these priorities. At the same time, they are facing a funding squeeze, a very difficult condition. So in this environment, what we've seen in the debt dynamics, especially in Africa among low-income countries, is that debt continues to rise. And part is because the deficits remain elevated, but the other part is because interest rates are rising. And many countries that have also seen depreciation of the currencies, which also raises debt. So this has created or intensified debt sustainability concerns that will need to be addressed. At the same time, you're dealing with these very difficult conditions, including food insecurity. As was mentioned, more than 130 million people in Africa alone are living under extreme food insecurity. So what we recommend in these perspectives, yes, you need a tight fiscal policy for the reasons have been already mentioned. One is obviously to contain inflation, but the other is these heightened debt sustainability concerns and the lack of access to financing under these much tighter global financial conditions, especially for low-income countries. But how to do this in a way that protects the most vulnerable? Two things we see is, one, tax revenues remain very low in most low-income countries, including in Africa. For example, tax revenues in low-income countries remain 5% of GDP on average below emerging markets, and they're half of the tax revenues in advanced economies. So more efforts to increase tax capacity, create fiscal space, not only to manage the debt burdens, the rising debt burden, but also to address these other priorities, including achieving the development goals. The other part we see is improve the quality and efficiency of spending, including in many of these countries, you have untargeted subsidies like energy subsidies. Restructuring these subsidies, make it much more targeted to those more vulnerable, will first help those who really need and increase savings for other priority spending. So these are broadly the key efforts we see for countries to do. And of course, as Vitor already mentioned, we need and we are calling for support from the international community in terms of debt relief and helping on the debt restructuring efforts.
To avoid your question at all, on the Russia-specific question, one of my colleagues will answer that one. So your question, I believe, is very good because, of course, the developments on global public debt summarize what's happening in the world, but it's very clear that there is enormous differentiation in the world. For example, I stress the very fast increase in public debt to GDP projected for China and the US. At the end of the period, both China and US will have public debt levels well above the average for the world, but the two largest economies in the world have capacities that most other countries do not have. So the point is, one size does not fit all. You have to go through the specifics of the country's circumstances if you want to give policy advice and if you want to evaluate public finance risks. The second point that I want to stress is that there are no magical numbers. The numbers are a very good starting point for a conversation. They help structure the analysis, but there is no mechanical mapping between a number and a policy conclusion. That being said, Larry, I think it's clear that given the very strong response of fiscal policy to the pandemic shock, and the fact that some countries were clearly not able to respond to the same extent as others, the fiscal space, the financial capacity was playing out during the pandemic. Buffers were used. In some cases, buffers were exhausted. Higher debt and deficits configure a situation where public debt risks are more pronounced. And so in our view, the case for prudent